Well, as expected, the Fed raised rates yesterday. How far did they go? Did they go up? Did they go down? Let's talk about it. Today is the 27th of July, Thursday. Hope you're doing well. Well, the Fed did raise rates yesterday 1/4 point. That was fully priced into the markets going into yesterday's meeting. We did not expect to see much movement in rates, and sure enough, we actually saw rates come down pretty significantly yesterday afternoon. They came down about 1/8 point midday. We saw that change direction quickly this morning. However, we got Q2 gross domestic product, GDP, came in at 2.4% today. That immediately took those gains away from us that we saw from the Fed hike yesterday, and we saw interest rates significantly higher this morning. In fact, we are sitting at multi-year highs, 7.09% in the Mortgage News Daily tracking poll. We were at 7% even last week. 30 days ago, we were at 6.92 in that same tracking survey. Freddie Mac has us at 6.81 today. Mortgage Bankers Association has us at 6.87. Those are actual rates tracked nationally on what people are closing at. Now, they trail about a week behind the market, but I would suspect that most lenders are going to be pretty close to that range. We're going to be in the upper sixes across the board for the most part. Some buyers may choose to pay some discount that'll get them closer to the mid sixes, but I think by and large, you're going to see most folks closing in the high sixes right now. As we discussed, gross domestic product came in stronger than expected. The market was expecting a 1.8% increase. We got a 2.4% increase in Q2 gross domestic product. Now, a lot of folks have been predicting a recession in the not too distant future, if not already in place. This GDP pretty much puts that on the back burner for the rest of this year. Remember, the recession is going to be 2 down quarters. So we would have to see a major reversal in Q3 and Q4 for that to occur. So it's very unlikely we're going to see a recession in calendar 2023. The reason that's important, y'all, is if we do get into a recessionary environment, that is going to put the skids on our inflation that we are seeing. That is the one thing that really will put the clamps on this thing, and that's what the Fed has been working towards. They would love to engineer this perfect scenario of a soft landing of the economy where they continue to hike rates without throwing us into a deep recession, while at the same time killing this rampant inflation that we have seen over the last 2 years. We have seen interest rates come down a hair in exchange for inflation reads coming down. We're sitting right at 3% for inflation on an annual level right now. The Fed tracks that very closely, y'all, and the future of Fed hikes is going to be interesting from here on out. The Fed has been at their prior meetings pretty clear on when they're going to be hiking at a next meeting, and they have done so, and they really haven't surprised the markets at all. We've talked a lot about that on this call. What we are seeing, though, for the future, the Fed hike coming, or the Fed meeting in September, there's only a 22% chance that they're going to hike at that meeting based on how the market is trading today. There's a 32% chance that the Fed will hike at their November meeting. The markets are really starting to price in the possibility that the Fed will hike one more time this year at either the September or the November meeting, but that's going to be data driven. Powell's comments after the Fed meeting yesterday indicated that data is going to drive what happens at either of those two meetings, which means reads on inflation are really going to drive that calculus on what the Fed does from here. So we do get personal consumption expenditure tomorrow. That is the Fed's favorite read on inflation. We may see that one surprise to the downside, meaning that it's more favorable, showing inflation in check than prior reports have been. If that proves true, then we may see the gains that we saw today in rates. Maybe we see that come back down again. I would not be locking rates today. I would wait until tomorrow. Damage is already done. Lenders have already repriced at these higher levels. Let's go ahead and see what PCE looks like tomorrow to see what that may bring us as far as rate relief. In any event, this really is a day-to-day equation, folks. So many prognostications about where rates are headed have been proven wrong in this market. And it's interesting to see so many folks out there that are well-versed on this topic having contrary views on where we're headed. So I do my best to navigate through it. I hope this information is helpful for you and for your clients. And as always honored to have your referrals, blessed to receive them. You have my contact information on the screen. Stay blessed, stay safe. We will talk to you next week.